All right, hello everyone. Okay, evening. All right, evening everyone. Now, welcome to day 19 of Project Options Cashflow. All right, this is Impossible Terrence Tan speaking with all of you. Okay, now, hi Uncle Tan, hi Uncle Fu. All right, hi Said, hi May. All right, hi Yiling. Okay, now, so if you have joined us in the room right now, drop a note, leave a comment, say hi, right? And all right, assist us as usual to click on the share buttons for today. Now, today's topic is going to be about how you could make use of options and option strategies over here to manage your risk. Okay, now, so today, if you are owning some stocks right now for whatever reasons and you have some profits on them, okay, if you're thinking about managing the risk, all right, keeping the upside, but making sure that you do not lose all the profits that you already have made so far. Today, we are going to talk about this. Okay, now, so welcome to those who have joined us early into the session. Hi, Gideon. All right, I hope I pronounced that right. All right, we'll just give a couple of minutes for more to stream in over here on TGIF Friday. Okay, and we'll start the session officially. All right. Okay, all right now. So while waiting for the others, let me just go through some nitty-gritties over here. If you have not been part of our Junhao, right, Telegram channel yet, today our stock lingo for today is book value per common share. Oh, book value per share. Okay, now this is basically that in the event of a liquidity, the book value per common share indicates basically the dollar value that remains for common shareholders after all assets are liquidated and all debtors are paid. Okay, all right. So this is a fundamental characteristics of a company. Okay, fundamental valuations basically. Okay, hi James. Hi Chin Kyung. Okay, great. Now, so let me get today's session started. It would help. Okay, it would help if any of you have traded some stocks. That means during this period where the market collapsed back in March, you have actually went out there and bought some stocks and are holding on to those stock positions up until now. Okay, but you think that there's more upside, and at the same time, you also fear that if the market collapses again, you might actually lose all the profits that you made. If you are in this situation right now, okay, could you help me by bringing up an example so that everyone can understand in today's session and benefit from it? So if you have a stock sitting in your account right now that's under this situation, could you leave the stock symbol in the comment section? Okay, and we'll use that as one of our highlighted examples today, okay, when we go to the trading platform. Okay, all right. So those of you who have just joined us as well, all right, do assist us to click on the share buttons over here, all right, to let us reach out to as many people as possible. Today's topic is pretty interesting as well because we're going to discuss and talk about how options can be dynamic enough, right, to allow you to swap out the risk, okay, that is always present when it comes to stock trading. All right, without further ado, let me get started with today's session over here. Thank you for dedicating your Friday night to me, all right, and trying to pick up some skill sets with options today. Now, so I hope I don't disappoint you on Friday night, so let's get started. Now, welcome to Impossible Investors, a 30 days challenge over the month of June, okay, and we call this Project Options Cashflow. So what we're trying to do over here is to debunk the myth of options, that it's risky, it's dangerous, okay, but quite the contrary, if you know exactly what you're doing, it's pretty safe. Okay, now before I go further, I just want to talk about something that I actually forgot to discuss yesterday. Okay, if all of you saw a post that I made in my Facebook page, it was about the Robinhood trader who unfortunately committed suicide because of the negative balance that he was seeing in his account. Okay, now, so if you read the details, it seems that the only detail that was shared, okay, was the fact that he had some put spreads in his account. Okay, now, so for whatever reasons over here, okay, now the put spread may be in a situation where the stock was sitting somewhere in the middle of it. Okay, that means it's sitting somewhere in the middle. Okay, now, but do understand this as well. If you actually know what you're doing, okay, it wasn't, as scary as what he may have seen, all right, appeared in his account over here. Okay, now let me show you what I'm trying to stimulate or represent. Now, so basically what happened was, he had a put spread that was started off perhaps something like that, right? The stock was sitting above, right? And, maybe the market collapsed. It brought the stock all the way down here, perhaps from last Thursday collapsed over here. So it's sitting in the middle of two different strikes. Now, so if he sold this put option over here, all right, and then bought a lower strike put option, okay, he would be in a situation where the obligation would have kicked in, right? And the obligation clearly states that he would have to buy the stocks, okay, right, which may have been assigned to him, right? That's why the ownership of the stock would have caused such a huge negative balance, right, that is reflected on his account. Okay, now, and at the same time, he would have a buy put position over here, right, that was meant to protect and cap the maximum loss on such a trade structure. Now, however, when it lands between over here, right, this right did not kick in, right? So the only thing that was, happening right now was the obligation for you, right, to actually go out there and buy a share, right, if you don't do anything at all. Okay, now, so that means if you don't close the option trade, right, this is what's going to happen. Okay, now, but what you realize is this negative balance over here was an occurrence of the fact that the stock was actually assigned into your trading account. Okay, but if you kept calm enough, then you realize one of two things, right? If your account was basically in what we call a margin call status, okay, now a margin call can be really scary for a stock trader, right? But if you are an option seller and you know what you're doing over here, right, a margin call is simply another step in the process. Okay, now what do I mean when I say another step in the process over here? If you started selling options and you never had the intention, right, to actually buy or own those stocks, right, this may be a strategy that you have done, right, which means to sell a put spread. Okay, now, but unfortunately, it landed somewhere in the middle. Okay, now, which also means that max loss was not hit. Okay, you were only losing somewhere in the middle over here. So let's start putting some numbers. Maybe the stock was at 55. So you sold a 50 put option, right? And then you went out there and bought a 48 put option, which means for this entire trade over here, okay, you would have a $2 max loss. Now, a $2 max loss would have been $200 per one option contract. Okay, per one option contract. Now, so if we discuss this in more details over here, right, if the trader somehow ignored risk management, right, it says that he had about $16,000 in his account, okay, he could have afforded up to 80 contracts, okay, 80 contracts over here, okay, for the capital that he had in his account, right, for such a trade structure. So if he actually did that, he went out there and sell 80 contracts over here, each of them with a $2 max loss, okay, but what he was ignoring up front was the fact that the cost of owning the share was actually $50. Okay, Uncle Fu, I'll discuss those in a while, okay? Right now, so he ignored the fact that he may have a potential obligation to own those stocks at $50. Now, but do you realize 80 contracts of options would be equivalent to an ownership of 8,000 shares. Okay, 8,000 shares. Now, if you work that out over here, 8,000 shares times the cost of owning per share, which is $50 over here, right? That will put the number at 40, right? And then with 1, 2, 3, 4, right? 4 more zeros behind that, right? Now, so that will mean that, the ownership of the stock, right, on assignment would have cost his account $400,000 US. Now, so obviously with an account size of $16,000, right, he will already be looking at almost 380K, right, in negative value. So this could have possibly been the reason why he freaked out over here when he saw his account with a negative balance, right? But the actual fact was simply that he was assigned a stock, right? Now, if he knew what he was doing over here, all he could have done was this: let the broker sell the stock because there was a margin call. Right now, so if he let the broker sell the stock, okay, if he lets the broker sell the stock, which is probably somewhere here right now, okay, the price may be something like 49, right? So when the broker liquidates the stock over here, what it's going to do, right, is the broker is going to sell 8,000 shares at $49 each, okay, at $49 each. So if he realized after that, right, what he would have actually lost was only 80 contracts of options times 100 shares times $1. All right, now it's not small, right? But it would have only wiped out half of his account, right? So he wouldn't have lost as much because he only lost $1 on the share, right? $1 on the share. Okay, now which means for 8,000 shares, that would have equate to $8,000. Okay, now so one simple thing was just to let the broker sell off the shares at market value, okay, and he would have got all his balanced capital back. Okay, second, right, if the broker didn't do so, right, you could have gone into your account, click the sell button for the shares, right, and based on this price as well, you have lost the 8,000, and after selling those shares, you would have seen 8,000 balance on a positive figure in your account. Okay, all right, now, so I just want to discuss this fact over here, all right, and whatever you do, you should always be aware of, what exactly are you doing, okay, because if you don't, that's when things get scary. Okay, that's why, when people say options trading can be scary, it actually isn't, right, but you do need to spend some time to understand the rights, right, and the obligations of you buying an option and you selling an option, right? Okay, now that's it. Okay, now, so is this clear, everyone? If it's clear, could you just leave a comment, all right? Just mention clear, all right? And I know everyone got it. Okay, I can move ahead from here. Okay, I can move ahead from here. Okay, now, so while I wait for the others to signal clear, let's answer Junhao's question. So Junhao was basically saying that you will incur margin charges in this case. Yes, the answer is yes, margins will be charged because you didn't have enough capital to own those shares, so brokers had to lend you for the very short little period, right, which you realize was just a couple of hours before they were liquidated anyway. So the interest charge would have been less than a day over here, right, on the brokerage account. So I would basically weigh that as, negligible, yeah, right, negligible. Okay, all right, now, so nothing to worry about, again, if you know exactly what you're doing, all right? Okay, all right, now, welcome, Gary. All right, welcome. All right, now, that's the purpose of Project Options Cashflow anyway, right? The whole purpose is to clear up any doubts and any misconceptions that anybody may have, right, with regards to the fact that options trading is actually something that's really risky, right? Quite the contrary, all right? It's actually one of the safest strategies that you can adopt out there while you're making money in the markets, right? Just, you need to know exactly what you're doing. That's all. Okay, and that's what we're trying to debunk over here over the next entire 30 days of June. Okay, we're nearly past halfway there. All right, just keep going with me. All right, there's still much more to be learning, and it's going to get quite exciting over here. Okay, now, so moving along, right? Standard disclaimers for each session. We'll be discussing trades, so do your own risk assessment before you decide to take any actions. Okay, now. So today, Project Options Cashflow is on day 19. We're going to discuss managing portfolio risk with options. So how do you speculate with profits protected? Okay, pros and cons of the strategy, and then we'll go to some live examples. Okay, all right, now, so I've spotted some errors again, so give me a minute, everyone. All right, give me a minute. All right, good to go. Okay, now, so risk management with options. What does it mean? Okay, now, it simply means this. If you have bought a stock, okay, if you have bought a stock at the bottom of the market, so let's say you bought a stock that was, bottom out at $50 when the market hit bottom in March. Okay, so you went deep down inside and you decide, okay, this is a bargain, I'm going to buy it now. Okay, so you bought the stock at 50, and then over the last 2 months, the stock recovered, right? And let's say it recovered to $80 now. Okay, so what's happening right now is, of course, it could go even higher, or it could, we could be facing the next sell-off in the market, and it could drive the stock all the way back down to 50 again. So what you have over here is probably a risk of loss of $30, which is the profit you made. Okay, but okay, you are also looking at a possibility of more upside potential. Let's say before the market crashed, the stock was actually trading at $100 before it crashed. So perhaps you're looking at it going all the way back to 100 before you want to sell it off. Okay, now, so you're looking at an upside of another $20, but the $30 potential of loss of profits may actually end up leading you to taking your profits and selling off the shares. And if the stock goes up, you feel really painful because you felt shortchanged over here. Okay, all right now. So what you could have done over here is to swap it out. Okay, now what do I mean when I say swap it out? Simply, all right, go ahead, sell your stocks. Okay, all right now, sell your stocks because you felt that the downside risk was present. Right now, then what you do is once you sold those stocks, you have collected your profits that you made. Okay, use part of those profits, okay, and pay to buy a call option. Simple as that. Okay, because when you sell your stock, what you do is you collected your profits, which is in dollar terms. So if you bought the stock at 50, all right, and then I sold the stock at 80, that means I'm collecting and realizing my profit of $30 per share. Okay, now, of course, I'm sure $30 per share is going to be good enough, all right, to afford any call options that you're going to buy out there. Okay, so you could buy something that's right on the dot, right at the money, which we call it, or you could buy something that is in the money over here. Okay, now, so you pay after that to continue to speculate. Now, what happens then is there's going to be a difference in amounts, okay, and you get to keep all the remaining amounts, which is going to stay in your pockets anyway, all right, and that's your profits to keep. That means you book a permanent profit, all right, but yet you're taking a slice of it, all right, for buying a call option for you to continue to speculate over here. Yeah, all right, now, just a quick example, right, let's say Disney was the stock. Right, so you bought Disney at 50 over here, right, and it shot all the way back up to $117 right now. So you're really happy because you doubled on your initial investment, right? So you might think that Disney could continue to go back up to 140 where it fell from, right? But at the same time, you fear it could go back down as well. So what you could do is you realize your profits where you bought the stock at 50, for example, right? So you're realizing a $57.96 profit, okay, by selling the stock at the price you see on my screen. Okay, and then you go out there and you turn around and spend some money to buy 115 call. Okay, now, so what does it mean when you do so? All right, it simply means, all right, that any further upside is going to bring you more profits, okay, all right, onto the table. But if it falls, all right, you have already kept all the profits available. Okay, now, so let's take a look at how much this trade would have cost. If you bought, in my example, I say I bought the stock at 90. Okay, all right now. So let's say you bought the stock at 90 over here on 19th of March, and now you sold Disney at 117.96. So you have made a profit of 27.96. Okay, so 27.96. Let me write it up over here. Oops. All right, come over here, 27.96. Profits from the stock. Okay, now, so this means I could spend anywhere up to 27.96 to buy a call option, all right, and anything less than that would still leave me with some profits to keep on the table. Okay, now, so if I go out there and buy a 17 July, right, call option, which is 115 strike, 115, 17th of July, all right, which, you know, when we did this example was worth another 2 months out, okay, I would have spent somewhere around 840, right, to buy this put option, right? 840 to buy this put option. Oops. Why did it go back? All right, sorry. Okay, now, so that means after paying, it's real. Okay, after paying for this option over here, what's going to happen is I get to keep 1956 that is sitting in my pocket right now. Okay, and this 1956, right, is what we call locked in. Okay, all right, so these profits are locked in over here, which means I will not be losing any of these profits, all right, from the trade that I'm trying to continue. Okay, because I paid for the option outright, which means, all right, the maximum I will lose from this trade is the 840 that I paid for the call option. Right? Can I lose less than that? Yes, definitely. All right, anytime you want to get out of your option, you just sell it off, all right, and end the whole trade. Okay, but okay, you have kept 1956 in your pockets, yet you maintain the upside if the stock continues to go up. Right? The call option is going to bring you more and more profits, right, when you do so. Okay, right now I hope that is clear. Right? If you have any questions, this is the time to start pushing it out on the comment section so I can clear up those doubts as well. Okay. Now, so how do you use this strategy? Okay, it's about focusing on keeping profits, yet you still want the avenue to be greedy. Okay, so similar to what we said yesterday, have the apple and also eat it too. Okay, have the apple and also eat it too. Now, next, you are also trying to control your risk in the event that the market will collapse. Okay. Now, so in the event, like what happens last Thursday would have happened again, all right, you would have kept all your profits because they were already taken off the table. Okay, even massive stock gaps over here will be averted. Okay, now, because the biggest threat to stock ownerships over here is not it going down, right? It's actually a gap on the open, more so with a gap down. Okay, now, so these gap downs will be averted because you have paid for the call option, which means you will never ever lose more than what you have paid for the call option. Okay, now, so this should be executed on what we call low or non-dividend paying stocks. Okay, so maybe you bought a dividend stock, but you realize, okay, that the dividend payment was really low, or when you bought the stock, the dividend return that it was given was actually very low. So it makes no sense for you to continue holding it right now anyway, right? If you have such a big profit that you can take only in a short span of 2 to 3 months. Okay, now if that's the case over here, then you could continue to speculate on the profit, right? Wow, okay, actually taking profits off the table. Okay, and non-dividend stocks, then it would have made even much more sense over here. Okay, to speculate with options, all right, since you have already made the money on the stocks. Okay, keeping those stocks aren't going to pay you anything more as well anyway. All right, so what's the point? Okay, so this is called speculating smartly. All right, speculating smartly. All right. All right, now, so thanks, Lydia. I see you probably tagging a friend over here. All right, yes, this is definitely something you can tell your friends about if they're still trading stocks right now. Okay, so if they're still trading stocks right now, this is the moment where you realize you have something convincing to tell them, all right, why they should go to our website, all right, why they should go to our website and start, all right, putting themselves on Project Options Cashflow. Okay, so go to our website, tell them, all right, look for Project Options Cashflow and opt into it, so they'll be sent day one right from the beginning. Okay, so they will be able to understand buy call options. Okay, and when it comes to this chapter, they will understand why it works in this manner. Okay, all right, now, so I have many grads who are joining me in this room right now. Okay, but if you're our grads and you learned something new today, okay, could you type in the comments new? All right, so I have an indication as well. Okay, so if you learned something new today, just leave a comment and let me know you learned something new. Just type new would do. All right, keep it short. All right, new would be sufficient. Okay, meanwhile, while waiting for the comments, I'm just going to go ahead. So pros in the strategy, there's little or no risk because you're only going to do this when you have already made profits on the stock. Okay, now next, this is risk-free income. Right, it's risk-free income because you already made money on the stock. Right, what you're doing right now is just swapping the stock, right, for a call option. Right, buying a call option gives you the benefit, all right, if the stock goes up. So you're betting on the upside anyway. Right, but this time you're betting on profits that you have already made, right? And you're not betting on the entire profits. You're betting on a small chunk of the profits that is already in the bag. Okay, right now, thank you very much, all right, for letting me know you learned something new. Right, that's the whole purpose that I would set up the 30 days challenge for as well. Right, so that's great. Okay, idea. Right, thanks, Maureen. Right, okay, now, yes, definitely. All right, so there is going to be a lot of golden nuggets as we discuss strategies each day at a time. Right, so if you're able to pick out the core idea of each strategies that are being discussed, right, there is actually a lot of things you could have learned over the course of the month. Okay, now cons, is there a con to the strategy? Low ROI, I'll actually challenge that. Okay, I'm not sure why I put that down over here. Right, low ROI if it doesn't go up, all right, but if it really continues to shoot up, the ROI can be really, really interesting. Okay, now capital intensive, yes, definitely. Right, so if the stock has gone up, buying a call option that's at the money, it's going to be costly. Right, but you're using your profits to pay for it anyway. Right, so keeping the stock would have actually been costlier, right, in terms of a risk perspective. Okay, right now, so cons over here, I will take that away. I'll probably, I probably copied this from some other slides, but I didn't, erase some of the details. So I'm going to do that now. Okay, give me a minute. I'll come back over here. So I'm just going to remove. I'm going to remove everything. All right, now, so actually, all right, because today's topic on this strategy is actually managing risk with options, right? And it's talking about how you can continue to profit, all right, without, the risk involved. So I would assume, all right, swapping a stock out for a call option provides no cons, right? Oh, I just thought of one, right? There is a con. right? The con is, right, you may actually end up, wait a minute, right? You may end up with the loss of dividends, right? Because if you swap out a dividend paying stock, right, for a call option, you are no longer entitled to the dividend payments, right? So this is probably the only con you could think of over here, right? Because while chasing the profits this time with a call option, you are no longer entitled to the dividends, okay? But usually the dividend is considered a small amount, right, to the risk if the stock actually plunges again. So I think, it's barely a con in this situation, okay? All right. Now, just to put into context over here, the whole Disney example, I'm just going to go ahead and show you, right? So Disney was looking something like that, all right, on the charts form, right? So we realized that it was in the channel, all right, and it's kind of breaking out from the channel, right? So while we are, clearly positive, all right, or optimistic that the breakout will continue, right, which means Disney may surge higher, but at the same time, right, Disney may actually come back lower, right, into the channel, right, and actually go back down as well. Okay, so this is the point where you decide, okay, I'm going to swap out. Okay, I'm going to swap out to a call option, right, and if it continues to surge up, right, you can still profit anyway. Right now, so let's take a look at what kind of profits you can look at. So let's say if Disney went your way, it continued to shoot up to $140. How much profits can you make right now? So if this is the case, we bought the 155 call at 840 right now. On expiry, that means on 17th of July, if Disney stock was actually trading at $140, right, we can calculate what's the option premium just simply based on the claim value, right? The claim value. Right now, what do I mean by the claim value over here? Right, we just need to take 140, right? Typo error, 115. Right now, we just need to take 140 over here minus 115, right? And immediately you know that there is a claim value of $35 on the table, right? 115. Yes, that's right. Right, so there's a claim value of $35 on the table. So the price of this option on the last day will probably be trading at a bid and ask of around $35. Now, that means when you close this trade right then, okay, you will realize another further $35 in profits right now. So paying $840 for it means the net profit would have been $26.60 divided by the $840 that you paid. That's 317% in 2 months, right? Buying this call option over here. Okay, right? What's your downside? Your downside is $8.40. Okay, which means if somehow, some wonder, right, and it caused Disney to collapse and go bankrupt, all you lose is $8.40. Right? You don't lose anything about the share at all. Yeah, right? Now, so if the stock goes up to 140, right, your profit from the premium and it's up to $26.60. That's 317% in 2 months. If it stays at 118, okay, which is where we started, the option value on expiry date is going to be worth $3 in claim value, right? So you have lost $540 from your initial investment. Now, if the stock goes back down to $90 again, right, you have lost $840 on the call option because you paid for it and it's going to expire worthless. Okay, right now, but if it went to 90, okay, you have lost $27.96 of profits if you had kept the stock. Because when we started, the stock was at $117.96. So if it went down to $90, you have lost $27.96 on profits that you could have made on the stock. So if this actually happened, I think switching out $840, right, for $27.96 is actually a pretty good decision to be making. Okay, all right, now so I'm done with the examples. Today is a pretty short one over here. Let's get to some trades over here where we can probably look at some live examples and talk about how we can handle them. All right, so Uncle Fu brought up some stocks over here. All right, so Uncle Fu, all right, now can you tell me some of the stocks that you have entered over here? All right, let's talk about something that you probably bought them more recently. All right, so you mentioned 3 stocks over here. Right? Could you just mention which one you have bought more recently over here? right? Perhaps in the last crash or the last couple of months, right? And what was the entry price that you paid for those shares, right? It will help me cite an example so I could use it as an explanation. Okay, all right. Yes, Wing Kai, you got it right. If the stock goes back down to 90, we have lost 840 on the option. But if you think that's a good price, all right, you could have always bought back the stock all over again. Yeah, okay. But it may also be wiser to buy a 90 call. That way, you will still not risk, much downside, because all you risk losing over here is what you're going to pay for the $90 call option. Okay, all right. All right, Uncle Fu, are you with us? All right, if you're with us, just leave a comment and let me know which share you bought recently and what was the entry price that you paid for it. All right, for those of you who have joined us late in the session today is an interesting session because it's not one of the strategy, but it's just more in terms of trade management and how do you handle risk and the dynamics of options as a whole. Okay, all right, so KO 43. Okay, we'll look at that. Okay, now, so if you have not clicked on the share button over here, could you just help us, right? And just simply click on the share button. Okay, now, so Uncle Fu said KO at $40. So let's go take a look right now. I'm going to swap out the screen, okay, and I'm going to go to the brokerage platform. Right now, so brokerage platform, let's go to KO. Okay, now, so if Uncle Fu bought it at, over the last couple of months when Coca-Cola was $43, that means right now he's sitting on a profit of about $4.55, right? $4.55 profits on Coca-Cola right now. So having said that over here, right, if he worries that, next market sell-off, Coca-Cola may come down again, right? This is the time where you do some trade management. So let's say, Uncle Fu believes that in the next 2 months, market may crack up, it may recover all the losses it made, right? So that would mean that Coca-Cola as an index stock will go higher as well, right? So there is going to be some upside. Now, so Uncle Fu has made $4 so far, $4.55 on the stock, right? Definitely you don't want to risk every cent of it. So I would say the best strike call option you could buy is probably going to be the 47.50, right? 47.50. Now, so 47.50, let's quickly look at the chart for KO. So before the market crash, KO reached a high of $60, right? So let's take a look. Now, so buying the 47.50 call, right, would mean that he would have to spend about half the profits. Okay, half the profits buying these call options. Okay, half of those profits buying these call options over here. So if Coca-Cola were to come down over here, then he's not going to risk anything, okay, other than the half of the profits that he's going to fork out right at the beginning over here. Okay, all right, now, so that will be how you play it over here. Now, if Coca-Cola recovers all the way to $60 by August, let's say by August, right, the option, right, the market value for the option on the last day, it's going to be worth 60 minus 47.50, it's going to be worth 12.50. All right, it's going to be worth 12.50. Okay, right now, so if he bought it today for $2.30, let's say, right, and he's right, he got it spot on. Coca-Cola goes all the way back to $60, right, which could happen if we have the S&P going all the way back up to 3,400 levels, right? That could have dragged Coca-Cola all the way back up as well, right now. So if that happens, right, that means Uncle Fu will end up making a profit of $10 on this option trade, right? And that's gonna be 400%, right? 400% return. Okay, right? But he has to decide, is he willing to risk half of the profits that he made so far in the event that he's wrong? Okay, all right, or he's more comfortable just holding on to the stock, right? Because it is Coca-Cola after all anyway, right? So many people may have the view that, I might as well just hold on the stock. Because if I hold on the stock, then I won't have to lose this $2.30 that I have to pay. Yeah, okay. So it's pretty much a way of ownership on the stock versus, pure profits play. Yeah, okay. That's why we say, it's probably better on growth companies and non-dividend paying companies, right? Because on blue chip companies, that's going to be a challenge. Okay, it's going to be a challenge because, we talk about downside, but how much downside are you really looking at? Yeah, so is it worth paying for the option then? Okay, now so let's just do one more over here. VZ. right? So Uncle Fu bought it for 49, all right? Some great trades there, Uncle Fu, all right? Some really, really great buys over there, right now. So 49, same thing over here, 60 days option, right? So if he's going to continue the deal, right, he would be most cost effective to buy the 57.50 right on the dot right now. Okay, so he would have made $8.26. Okay, $8.26 on Verizon. Okay, in the last couple of months buying the stock. Okay, so that's pretty good. Right, that's a pretty good return. So spending about 170 of that to buy this call option, right, for the next 60 days would seem a much better deal than the Coca-Cola one. Coca-Cola one may not make so much sense, right? But this one would probably be right. Okay, spending 170 out of the $8.30 profit that it's already made on the stock so far. Okay, now, so I hope that put some light into the picture for you, Uncle Fu, right? So for AT&T, it probably won't make so much sense as well, right? Because it's only about $2.50 in profit so far. Yeah, okay, all right. So any options you buy is probably going to eat too much into the profits you're making. Okay, all right. So you realize one of the criteria over here is your initial profit should be something substantial enough based on the stock price. Okay, that would make it a smart decision, all right, to switch out the stock for options. Okay, now what would have been a really, really fantastic play? All right, let me show you one. Facebook. I can't deny the fact that we have so many Facebook fans out there, all right, on its growth potential as a company, all right. Many would have gone out there in the, fall in March, right, from 200 levels all the way down to 140, right. They may be tempted to acquire some Facebook shares when it rebounded a little bit to somewhere around 160. So if anyone bought Facebook shares at 160, right, today they're looking at a massive profit that is, like way over $50. Now, so if you bought it at 160, right, today it's worth 236. So that means you're looking at a profit of $96. Am I right? No. 86? No. 160, 40, 40, 37, 40, 37, $77. Pardon my math, right? $77, right? $77. So you have made a profit of $77 on Facebook. That's hefty. That's worth protecting, right? That's worth protecting over here. Now, so let's take a look. If you want the continued upside on Facebook, right, you could buy a 2-month option over here, right? That is right on the dot. So something like $240, right? Which let's do this. Let's do 235. All right, and you could see Facebook options are really, really liquid. All right, you could pay something like $16.60 over here, right, and bought Facebook options, all right, call options for 2 months, all right, at 235 call strike. Now, so if Facebook continues to go up, right, which it probably might because it is already making new highs, right? So nothing is going to stop it from going even higher, right? So let's say if it hits all the way to 300 in 2 months' time, right? How much is your call option going to be worth? Your call option is going to be worth $65, right? 300 minus 235, that's $65. So selling the option for $65 less the $16 that you paid upfront, that's still a chunky profit of about another $50 over here, right? Now, so if Facebook shares were to come crashing down again, nothing too hefty, but let's just say to this red line over here of $190, right? If you kept the stock, you would have lost $46. But by swapping it out to the option, the most you're going to lose is only going to be the $16 that you're paying up front. So $16.60 loss versus $40 over dollars on the downside. All right, weigh your pros, weigh your cons. Right, is it a smart move? If it is, it's time to make a swap. Okay. Now, James says, how about executing buying the call option and then turning around and selling a higher strike call option? James, if I got it right, that's probably what you're discussing about. Now, so James is probably discussing about something called the call spread. So he wants to buy the call spread. Now, so we've discussed this, if I'm not wrong, in the earlier days, probably day 5 or day 4. I think it's day 4. All right. So in day 4, we discussed buy call options, buy call spreads. So this would have been the strategy. James is doable, but the only problem is you're going to cap your upside risk. You're going to cap your upside profit potential. So let's say if Facebook, you're buying $16.60 for the 235, all right, and let's say you want to sell a call at $2.70, right? And you could sell it for $4. That means you lower your cost by $4. So you're only going to pay something like $12.60, right? So paying $12.60, right? But in exchange, right, if the stock goes up to 300, right, you're only going to make $35 in profits, right? $35 less $12. Remember that, okay? Because you're paying $12 upfront, okay? Versus $70 less $16, okay? All right, now, so what do you want, right? Do you think it's better on the profit potential, right? Do you think it really can go up that much? Or, you don't mind sacrificing some profit potential for a lower cost upfront? Yeah, okay. All right, now, so James, I hope, I brought some clarity to your question over there. Okay, all right, anyone with any further questions over here? All right, if you have further questions, this is the time to bring it up. Okay, now, the similar strategy, okay, I'm not going to go into detail, but I'm just going to briefly mention it. The similar concept can be adopted on short selling trades. That means if you short sold a stock over here and it went down drastically, you have profit from the downside, right? You could consider swapping the short stock position for a buy put option. Okay, it's just the total opposite over here. All right, now, so just flip whatever I just said to the opposite side, that would have mimicked the short seller's position. So if you short sell a stock over here, you're sitting on massive profits right now. Okay, you think it's going to go all the way to bankruptcy, but yet to, right now, but there's always an upside risk of a bounce. Then you should swap the short sell position on the stock for a buy put option. Okay, right now, so that's something you could consider doing. Okay, so I'm done with today's coverage of how do you manage risk with options instead. Is there any questions on the table for me? All right, so if there's questions, this is the time to bring it up. Okay, before I draw the session to a close. So while waiting for the questions, I'm just going to go back over to my slide. Okay, now, so tomorrow, not tomorrow, Monday. Monday is going to be day 22 of the challenge, right? On day 22, we're going to go into some options language, right? So we're going to go into options language, all right, on day 22. So if you've always been, marveled by, what's all these terms in options when I trade options? I don't understand that, right? We're going to start discussing them from the beginning of next week. So the first on the table is going to be, time value versus claim value, right? Which one is more important? Which one am I paying for when I buy the option, right? Which one am I getting when I sell these options, right? So we'll debunk them, all right, on Monday next week. Okay, right now. So again, if you've not joined our Telegram channel, right, and you're new with us today, you could do so by scanning the QR code or typing out the link over here. All right, now, and that will bring you to the Telegram app, loading up our channel, and all you need to do is to click join. Yeah, all right, join the channel. Okay, all right, now, alternatively as well, if you wish to, start the challenge all over again because you missed out on, many of those days, you find it useful today, you want to start it all over again, right? Then head over to www.impossibleinvestors.com, look for the same logo, which is Project Options Cashflow, all right, and then click on it, all right, and then opt yourself in, and our team will start sending you day one videos, all right, day by day over here. So you could restart the challenge on your own, at your own time, own pace. Okay, all right, any questions? All right, any questions so far? Seems like we're good. All right, now, so if we're good over here, I'm not going to hold all of you back too much longer on a Friday night after all. All right, so it's Friday, all right? We are free in Singapore right now, so go ahead, enjoy your Fridays. Go have, dinner outside or something like that, right? But meanwhile, stay safe, everyone, all right? Don't forget, all right, we're still in the midst of restricted movements to a certain extent. All right, now, so keep yourself safe, okay? All right, oh, yes, a question came in. So I'll address this before I close up. how do you do color trades in TD Ameritrade platform? All right, covered in yesterday's session. Okay, all right, so, okay, this is what I'm gonna do. All right, I'm just gonna head over to the brokers platform and just gonna show you quickly how you could do this and set this up. Okay, now let's just take Facebook. All right, anyway, I have it on my screen right now. Okay, and it's probably a good stock to have a color on anyway. All right, if you already have profits right now. Okay, now, so if you don't own the stock yet, okay, if you don't own the stock yet, that means your entire order would need to include, right, right, the stock ownership, right, the stock ownership. So you probably have to buy the stock first, right? So you click on the ask price for the stock, right at the top over here, right, the ask price for the stock. It will bring out the buying order for a Facebook stock, which is 237.33 right now. Okay, right, and then for colors, we'll go all the way to January next year, 2021. Keeping a little bit of upside potential means I would sell the 240 call, right? So before you click on the order, what you need to do is to hold down the control key on your keyboard. Now, look at my screen right now. I'm letting go the control key, okay? When I press, look at what's different on your screen. Okay, I'm gonna let it go again. Okay, I'm gonna press it right now. Okay, now, so it brings up what we call a hotkey menu on this TD Ameritrade platform, right? And what it does is when you hold down the control key, right, and you click another item over here, for example, sell call option, right? It's interesting. It doesn't allow me to do that. Weird. Oh well. You realize from this moment, I barely do it this way. Right now, let me see what can I do. Yes. Yes, I could probably do this. Let me see if I'm right. Sell 240 call. Right click. Sell. All right, I actually have a further menu over here, but it's not appearing on your screen. Okay, but when I right click on the bid price for the 240 call strike, okay, and I move over to the sell, on the next menu, you'll see this selection called covered stock. Okay, all right, you see this selection called covered stock. Alternatively, all right, you could also right click on it, select buy, all right, color. I think this should be right. Let's check it out. All right, buy color. All right, okay, now, but this color will be done without the stock. Okay, it's just adding on the option positions over here. All right, now, so let's do something instead. Let's do the call first. So I'm going to sell the covered call. Yeah, there we go. All right. Oh, no, this is not right. So I should be buying the covered call. All right, now, so I'll have to go to buy and then covered stock. That's the covered call strategy. All right, so covered stock. So plus 100 Facebook shares, right? -1 call option. Okay, -1 call option. Okay, now, so if you want to do the collar, Javon, all right, what I suggest is you first place the order for a covered call, right? You first place the order for a covered call, and then after that, all right, go ahead and buy the put spread. Okay, that means finish up this order, then after that, go and buy the put spread. Okay, now, let's see if I can get this done as well. Okay, the control key right now. Okay, let's see if they're gonna stop me from doing this. I'm gonna buy the 235 puts. Yeah, that's what I meant. They don't allow you to somehow mix up stocks with options over here, right? That's why I had to manually select, the exact strategy before they will allow me to do so. Right now, so the only way to do it is to execute this order, which is the covered call for Facebook shares. Okay, now, and once that order is filled, is done, it is time to go and do your put spreads, right? Now, so to buy the put spread, this is what you do. You click on the ask price for 235, So that brings up buy 235 puts, right? And then say you want to sell the 200 puts and protect about $35 worth of downside. So you'll hit the control key, right? And then click on the bid price for 200 puts. So that would mean 2 orders in one form, okay? Because you press the hotkey. Okay, now, so you buy the 235 puts, you sell the 200 puts, right? For a put spread basically, right? And you are required to pay $14.48. Okay, $14.48 to get this put spread done. Okay, you actually sold the call, right? You actually sold the 240 call for $30 over. So actually you're keeping almost you're keeping almost $19 up front. All right, so you get to keep almost $19 up front, all right, for this caller trade on Facebook. Okay, Javon, all right, I hope that answers your question that you were asking earlier. Okay, so let me just do it one more time. So pick your call strike that you want to sell. Okay, let's say you want to do the 245, right? Then, okay, you right click on it, select buy, right? And then, oh, it's not gonna pop up again. It goes to my other screen somehow. Okay, select buy, and then after that, select covered stock. Okay, this is the order form. All right, send and submit. Okay, and after the order is filled, right, go ahead, do your buy put spread. Click on the ask price, hold down the control key, right, and click on the bid price for the other strike put option. Okay, this is the put spread order on TD Ameritrade. Confirm and send. Okay, all right, now, so that's how you do it. Okay, well, okay, great, Javon. All right, welcome. All right, now, so I think we have officially reached the end. There isn't any other questions after Javon's question. Thank you very much for joining me on day 19 over here. Have a lovely weekend, everyone. I'll be back next Monday with all of you again for day 22 of the challenge at 9 p.m. Singapore time, GMT plus 8. All right, have a good night and a great weekend, everyone. Bye-bye. All right, bye. Welcome, Wing Kai. All right, welcome, Shani. Che Yin. All right, I hope I get that right. All right. All right, welcome, James. All right, good night, good night. All right, welcome, Maureen. Bye-bye. All right, good night. All right, welcome, Uncle Fu. Bye-bye.